Welcome to the MarketBeat podcast. I'm your host, Kate Stalter, and in this show, we cut through the noise and give you real market insights from professional investors, traders, asset managers, and analysts. Our guests put the market developments in context and give you actionable information to make you a more successful trader or investor. Let's get started. When you think of disruptive technology, what comes to mind? Electric vehicles, social media, 5G. Now, those are all great examples, but the tech industry is, by definition, always developing groundbreaking products and services that can dramatically change the way we live. Hey, it seems crazy now, but some of you, just like me, can remember when we didn't all carry these super capable little computers around in our pockets. That was science fiction stuff not even 20 years ago, really. So disruptive technology consists of innovations that significantly change the way consumers, industries, and businesses operate. A disruptive technology basically erases previous systems and habits because it brings characteristics that are recognizably superior. In today's interview, I talk with Robotics fund manager Bill Studebaker about disruptive technologies in some industries you may take for granted and not really give much thought to, like supply chain logistics and warehouse automation. Not something most people really think about when the idea of disruptive technologies comes up. But if you do think about it, it makes sense. With all the increases in online ordering, how do goods get tracked across the entire process, from getting to the warehouse, from being sent to the customer and arriving at their door? Well, it's more complicated than it may sound. And new technologies are making the process go more smoothly, which benefits both businesses and consumers. Oh, and investors, it so happens. Now, it may not be as glamorous as electric vehicles, but you've got some industry-changing technologies happening in all those warehouses that are popping up everywhere around the U.S. and around the world. So my point is, disruption isn't always something that's easy to see and right in front of you, like 5G or smartphones, but there's still plenty of world-changing opportunity right in front of us. Today's guest is Bill Studebaker of ROBO Global ETFs, which specializes in delivering innovative investment opportunities through its ETFs. Bill explains very well today what's happening with the downturn in robotics and AI stocks right now, and also gives us a roadmap of what could be ahead as the industry rebounds in the face of growing demand. Here's my interview with Bill Studebaker of ROBO Global ETFs. All right, Bill, great to have you here today. I want to start out with the most difficult question. I think it's probably the elephant in the room. But what is happening in the robotics, AI industry that is causing these stocks to decline at a sharper rate than the broader market? And I'm not even necessarily talking about the S&P. I'm just talking about the NASDAQ, which I think is probably a more apt comparison. But tell me what you think is going on that's causing this right now.
Right. That's a fair question. I think that's the same question a lot of investors are asking. And, so far this year, must say there isn't anything industry specific that's driving the negative performance within the robotics and AI sector relative to the broader market, other than no conviction right now and a material change in the risk appetite that's suffered due to, a rising, wall of worries, which I think you and a lot of your listeners are well attuned to, which would include, rising rates and concern of slowing growth and Fed tightening, mixed in with 40-year high inflation and a Russia-Ukraine conflict that's threatening, supplies of key commodities. And that's, put technology in kind of the eye of the storm. And the result has been very few places to hide. As you indicated, our index is off more than the market. It's off about 30% from its all-time, high in 2021. But, fundamentals, believe it or not, remain, quite strong across the board. And valuation multiples have compressed really under the weight of the fastest rates of inflation in decades, which is consistent with what you're seeing with technology. Technology is in the eye of the storm. So that's leaving the valuations of our index now more or less in line with historical average. So our index, believe it or not, trades on earnings. I mean, there's a lot of technology indices and such that, trade, on revenues, and a lot of those indices, I think, are really suffering pretty acute sell-offs. And, what I would say here, Kate, is importantly, we designed the Robo Index to weather storms like these. We understand that these sort of events do happen, but we are very steadfast in our belief that we're investing in best-of-breed companies with high revenue purity, with dominant market share, with technology leadership, and solid balance sheets. And however, there are periods like now where correlations go to 1. It's hard to navigate that. And however, we believe that this is the time to begin to invest in these companies, because these are the companies that are disrupting the world and really helping to drive, much needed growth and productivity.
Right. And one of the things that I've had this conversation actually quite a few times in the past week or so, in that there's a thought out there that perhaps there are just so many different concerns going on right now with the war, with, as you said, commodity prices being higher, with inflation, maybe some lingering concerns about COVID. I mean, there's certainly new lockdowns in China that could be a cause for concern just in terms of supply chain and manufacturing. So is your feeling that maybe some of your companies are getting swept up in just some broader concern that really has nothing to do with where they should be valued right now?
Well, I clearly believe that. I've been in the investment industry for 25 years, and I can't say any one year has someone got up on the top of their desk and yelled, "The coast is clear, there's no risk." And, every year the risks change. And, I would make the comment that despite the negative market sentiment, believe it or not, robotics demand, is booming. And the world's leading manufacturers of factory robots, are actually struggling to keep up. Entering 2022, Fanuc, which is Japanese based and one of the global leaders in industrial robots, was sitting on a record high order backlog, more than double that before the start of the COVID pandemic. And they're sitting on more than a full year worth of sales. And in fact, they just reported yesterday and reported their orders were up 11%, year over year to a new high. And believe it or not, North American orders were up a hefty 29%. So, and, as we head into earnings season, we expect orders of many of the other, Robo members, many names that, your listeners may be aware of, like Yaskawa or ADB and Teradyne, but I would say not exactly household names, or overly owned technology names, like the FANGs, continue to, we think are going to trend up, as a number of powerful drivers are in place. First, you've got e-commerce, the boom is driving really an insatiable demand for logistics automation solutions. You've got, new areas of warehousing and distribution operations that are evolving. You've got a rapid shift to electric vehicles that's pushing car makers towards modular and flexible production systems that are highly automation sensitive. And then third, as we all know, there are very pronounced labor shortages that are pressing and putting automation on the top of the business leader's mind. So to your point, having said this, there is an extreme level of bearishness, and that tends to be positive for equities as we look out over a reasonable period of time. And so we think that our sector is being mispriced.
And you alluded to some of the sub-industries in there and a couple of the one stock in particular that you own. Is that the Japanese stock you mentioned? Is that one that's in your portfolio?
Yes, it is.
Okay. So tell the listeners about maybe a little more about that one and about maybe some of the other stocks in the fund that you see as really having potential in the next, call it 3 to 6 months, that could kind of help lead the way out of these doldrums that we're in right now.
Yeah, well, maybe if I could just comment on a couple of the sectors that I think are going to kind of be real pivotal going forward. I can, talk about some names, but, without a doubt, we love logistics and warehouse automation, and we see significant growth in the years to come. I'm not going to go on the record of talking about what might or might not happen in the next 3 to 6 months. That's very difficult to know, and sentiment, can change. And, when it does, we think you're going to be rewarded owning these companies. But, think about when it comes to tracking our online orders as customers, we have one concern and one concern only, which is delivery time, and date. And, that sounds simple, but the back-end fulfillment process is really complicated, and it's driven by multiple automation technologies and solutions. So the fulfillment platform that's been developed by Amazon is really being attempted to be replicated globally. And COVID has only amplified this. And retailers, unexpectedly, as we now see, face a massive wave of online demand. And establishing an efficient and reliable supply chain is now a priority. And for investors, in disruptive technology, this transformation represents really an enormous growth opportunity in logistics and supply chain automation, which, believe it or not, is one of our top performing subsectors since we launched in 2013. So our index ETF has over an 8-year track record. So investors can kind of see what we've been, investing and talking about. So, we just continue to hear from retail logistics executives that, most of their warehouse systems and inventory management are not fully integrated. And that just leaves a lot of room for technology to help. So the need to think about for a highly flexible supply chain is becoming a requirement in this new era that we're entering. And the final point I'd kind of make is that consumers, are the driving force in this new decade. With increased demand, you've got higher expectations of product quality. We now, are going in and we want to create our own products. So there's a lot more customization. And, we believe that much of this, or I'm quite certain that much of this is going to require a constant stream of innovation and technology investment to redefine the supply chain. And this is all driven by, automation. So, in essence, there's just no secret that the race is on by retailers, by manufacturers, by logistics fulfillment companies to, adjust to the ever-changing needs. And this is going to go on for years. So this is the area that I think investors really want to be invested. We also, love, what areas are going to be disrupted by robotics and AI. And my colleague, Nina Deca, was on with you not too long ago where she talked about healthcare. And so one area that robotics is really transforming is in that of surgical robotics. And contrary to the name, robotic surgery is still performed by a surgeon, and they use a computer to control a robotic arm as it operates on the patient. And the robot's arm, it's steadier and it's actually narrow than a human hand, and therefore can help, surgeons access areas of the body that are very difficult to reach and without tremors. So they can make small incisions, drives lower recovery times, and they use machine intelligence in robot-assisted surgeries to drive efficiency and extreme precision. And all this results in, better outcomes. And right now, only 3% of surgeries are done with robotics. And we think that further adoption is inevitable, and it's going to expand the market dramatically, as we go forward. So, we love that business because, surgical robotic providers operate on a razor blade model where revenue is generated through the sale of a system, and then they've got consumables and so forth. So it's a very, good business model.
Yeah, when Nina was on the show, we talked about intuitive surgical, which is certainly one, as I mentioned to her, that I've been aware of for 20 years maybe now. And that has been a very strong performer lately. And it's interesting because you're talking about retail automation as well. Some of these things are outside of what the individual investor or trader kind of sees in his or her daily life. Because I think maybe you've run into this too, that people's perception of robotics and AI might be something different than what's really going on behind the scenes and what they don't see. Have you found that?
Yeah, true. I mean, I think the important thing for investors and consumers to recognize is that we kind of have an undeniable inflection point because of performance capabilities of computing and the cost of computing has now created an array of use cases that years ago were just sort of Elon Musk science fiction. And what's happening in robotics and AI is that these are technologies that aren't necessarily changing, or eliminating certain industries. What it's really doing is that it's smart automation. And so we're really in the early innings of this to continue for years and years to come. And we're only going to get, better at it, as we have more data and more understanding of what we're doing. And Again, different than other technology, I guess, exposures. I mean, again, we're invested in real companies with real technologies, real revenues, and I think our investors are going to benefit here because, believe it or not, roughly about 40% of the index is heavily tethered towards value and to industrial automation. And we're still in the early innings of that cycle. These are cycles that don't just go on for a few quarters, but tend to go on, for a few years. And because of this, we have a much different sort of valuation profile than a lot of other, if you want to call them, technology exposures, have.
Not sure what stocks to buy and which to sell? Well, no worries. MarketBeat has you covered. Get the latest buy and sell ratings from Wall Street's top performing, most accurate, and most respected research analysts. That's just one part of what you will receive as a MarketBeat All Access subscriber. You'll also get MarketBeat's new trending stock lists, which monitor social media chatter in real time to help you identify the next GameStop or AMC before you hear about it on the news. MarketBeat All Access also features real-time news, market events, and performance data for your stocks with the MarketBeat portfolio monitoring tool. And you can take a completely risk-free trial for just $1 if you head over to the link we will put in the show notes. You'll get best-in-class stock research tools, performance ratings for Wall Street analysts, real-time news feed, executive support team access, all of this ad-free for just $1 for the first month. Sign up today. The link is in the show notes. Then let's jump right in. Let's talk about some of the stocks that you see as having particular potential then.
Well, there's quite a few. As just to kind of touch on the supply chain, I mean, we think there is a vast investable universe. Some of the companies in our index, I think provide unique exposure here, and they're names that are not owned by most investors. And just to make the reference, less than 3% of the companies in the S&P are in our index. So again, these are companies that investors don't own. So take, for example, companies like Teradyne, which is an undisputed leader in industrial automation. They have, over $3 billion in revenues and, 5,000 employees worldwide. And they're a top provider of collaborative robotic solutions for the manufacturing industry. They bought a company a few years ago called Universal Robots, which is a Danish provider that really helped accelerate their growth. They also have automated guided vehicles as another industry that they've purchased. So they offer really a broad range of automated solutions, for inventory management. There's other companies that some of your listeners may know, like ZBRA Technologies has been at the forefront of supply chain innovation, with providing mobile computing and RFID scanners. If you've bought something through Amazon, you're going to see that ZBRA pretty much tracks the product from when it leaves a distribution center to when it arrives at your house. And ZBRA's also made extensive investments in computer vision technologies, and they're working with the leading sort of retailers out there and logistic providers to drive and improve flexibility in their supply chain process. There's also companies like Manhattan Associates, MANH is the ticker, that's a leader in warehouse management solutions. So they have cloud-enabled solutions that help integrate data from really multiple inventory management systems. And what does that do? It helps you boost productivity, improve utilization. And they use machine learning and big data to integrate and manage warehouse automation so that, those technologies can work seamlessly. So there really are a lot of companies, to be honest with you, that a lot of people might not pay attention to that play a vital role.
And I'm pulling up the charts as you're speaking, and this is great because I am noticing the revenue and the earnings growth on each and every one of these. But kind of what struck me is how similar the charts are, that they've all been they went into kind of a free fall in January and then have been kind of chopping around the bottom more or less since then. And it's kind of to your point earlier about, perhaps that these stocks are just getting a little bit caught up in what's going on now in the current fears. And is there any concern, though, about how some of that might affect the earnings on these going forward?
Well, I mean, I guess we'll have to see as companies are going to begin to report this quarter. I mean, clearly, there are potential risks out there to the earnings, sort of outlooks for these companies. We'll have to watch. But I mean, if anyone's expecting a recession this year, I think the probability is extremely low, if not impossible, as we head into next year. It's probable. But if you, as I've observed, are sort of, consensus earnings expectations for the index, they are basically more or less flat year to date. That doesn't mean that there might not be a modest change, but I don't think that we're going to see, dramatic changes. I mean, back to Fanuc had just reported, and they put up relatively positive guidance. They did talk about margins being a little bit weaker than expected, and that had to do with supply chain, issues and procurement, and not related to demand. And so that's a little bit more important to me as a characteristic to follow.
How should retail investors who are listening to this and maybe are not as obviously as familiar with the industry as you are as a fund manager, how should people evaluate these various sub-industries without kind of getting caught up in a story or some hype? What's the best approach there, Bill?
Well, I mean, I think, in our case, what we're doing is that we're focused, again, on companies with real revenues that have, dominant market shares and leading technologies. And there has been a lot of hype, in the industry and in technology in general. I mean, I think we got to a point where the framework for valuing companies became very unreasonable. And if you looked at, for example, our index, the median market cap is around about 24 times earnings. And so if you were to look at, our index and sort of a bell-shaped distribution of earnings, you'd find a handful of companies that may have a higher valuation because the earnings are cyclically depressed. And if you look at the outside, maybe a handful of names would have higher valuations because they have higher multiples and have growth. But the bulk of our index, is sitting, probably around, 20 times earnings. And this is for technology. And we think what's really exciting about robotics and AI is that this is the future where we're going. There isn't an industry, or a geography that's not going to benefit by the utilization of these technologies to, guess what, improve productivity and generate, growth. And as we come out of this, there's no question that these are the companies, as we came out of the pandemic, that helped us drive productivity. If you look at the U.S. GDP, we came out of the pandemic with 1% higher GDP with 6.5 million fewer workers. I mean, that's the definition of productivity. And we think that as we look at every subsector of the economy, we're scratching the surface on where penetration rates are. So we are very bullish on the industry as we look out. And we think these pullbacks like this are an excellent opportunity for investors to begin to have some exposure.
Right. And that can be a little scary for people. But I really appreciate what you're saying here, Bill, is that, as you said, we are in the early innings of the adoption of this technology. And kind of given the case that you've made here, that certainly sounds very compelling.
We think so. I mean, again, it's pretty scary in the market right now. I think that the bearishness level is obviously very high. And, who knows where we go in the short term. I think a lot of these risks begin to get priced in the market, and there will be, a bottom put in. Exactly where, we'll find out. But importantly, we are exposed to areas that are not overly owned by the market. And as the dust settles, I mean, again, we think these are the technologies that are going to, drive the disruptions going forward.
Hey, really appreciate everything you've shared with us today. How can the listeners learn more about ROBO Global and the automation and robotics ETF if they are interested after what they've heard today?
Yeah, well, please feel free to go to roboglobal.com. We offer a significant amount of content for investors to read and get exposure to on our index. We give market updates. We provide quarterly updates, a lot of white papers. Our team participates in a lot of media events like this and others. And so there's a lot of opportunity for investors to learn.
All right. We will certainly link that up in the show notes. Thank you so much, Bill. Really enjoyed the conversation today, learned a lot, and I think the listeners have as well.
That sounds good. Thank you very much.
Thanks again for listening to the MarketBeat podcast. Do not forget to subscribe on Apple Podcasts, Spotify, Stitcher, Google, anywhere else you get your podcasts. And you will also find us on MarketBeat.com. If you enjoy the content here, please give us a 5-star review so others can also find all the great interviews and market insights that we bring to you each week. Also, did you know that MarketBeat has a YouTube channel? We sure do. The podcasts are there, as well as tips for getting the most out of MarketBeat and becoming, as always, a better investor or trader.